Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. And my name is Goose.
My name is Gabby.
Hey! And today we're talking about what happens when interest rates rise, which is a pretty interesting conversation. What did you think of today's episode, Gabby?
Lots of gold. Lots of gold. Lots of ways to think about interest rates that I hadn't really thought about. There's like correlations or causations with property prices, which is not really what you would expect, which is really interesting. The effect on rents and everything, what happens when interest rates go up, like what is the effect on rents in that situation? Yeah, I think it was a lot of interesting takeaways.
Yeah, I think it's going to be a very counterintuitive and challenging episode for a lot of people. And the reason is because everything we talk about in today's episode is based on facts, not opinion, but the facts fly in the face of popular opinion. So I think that for anyone who's ever thought about what happens when interest rates rise, how does it affect house prices? How does it affect rents? How does it affect affordability? All of this kind of stuff. I think there's going to probably be some eye-opening stuff that we talk about in this episode. And I'm excited for people to grow and to become more aware and more empowered as investors. That's the goal of this podcast. And I'm confident this episode is going to serve that goal. So Cool. Well, let's get stuck into it, guys. And of course, if you remember that if you like this and you think it's good and you think somebody else is maybe having a little panic attack about potentially interest rates rising in the future, send them this episode. Tell them, say hello from Goose and Gabby and send them the episode. Hello. And but yeah, make sure you like, rate, review, share, do all the good stuff, and tell your family, tell your friends, tell your loved ones, and help get this message out to other people. And of course, give us feedback. And if you have any suggestions of episodes that you would like us to record or topics you would like us to cover, make sure you send them through to hello@dashdot.com.au. But without any further ado, let's get stuck into it, and we'll see you on the inside. Hey guys, welcome back to the Investor Lab. Gabby, how are you today?
Wonderful. How are you?
I'm wonderful. I'm fantastic, actually.
Wonderful.
What's going on?
Just hanging out in the wardrobe again.
In the wardrobe. Gabby's back in the wardrobe.
Yes, spicy.
How is it?
Look, it's nice.
People are going to think we're like Harry Potter over here and you're living under the stairs or something like that.
Maybe I am. Maybe that's the twist.
That's the Investor Lab plot twist. Plot twist. Gabby's a wizard.
Don't tell anyone.
Cool.
What are we talking about today, Goose?
We're talking about interest rates, and more specifically, because I think interest rates is a bit of a shit topic, right? Just interest rates, right? Actually,
really sold it. You sold it.
No. But we're not just talking about interest rates. We're talking about what happens when interest rates rise, which is a really interesting thing. And I think this is a good sequel to our last episode, which was about inflation and what happens in inflation and what causes it and all of that kind of stuff. And I think this is a really good addendum to that episode and something that every investor should be thinking about. So, yeah, that's what we're going to be talking about today. Gabby, how do you feel about that? How do you feel about this?
Great. Where do we start?
That's a good question. That is a good question. Well, we've got a few notes here. Where did you want to start? You wanted to start with like, why do we even get charged? I want to start with like, what happens to rents? What happens to property prices? But should we like take a little step back?
Should take a little step back.
Okay, where do you want to start?
I want to start with like, just do a few minutes on interest rates, why they exist, why do we get charged interest, how do like banks figure out what interest to charge.
Did you just say do a few minutes on this? Like, as in, like you're telling me like I'm some dancing monkey? Could you just do a few minutes on do a few minutes on this?
Please, monkey. Okay. Please.
Now taking requests. Well, we want to let's get a little. Yeah.
Hey Goose, why do we get charged interest?
Because that's how banks make money.
Okay. Next question. What affects the rate that we're offered?
So yeah. So just to expand on that, I mean, just like I mean, I think it's obvious, but just in case it's not, just in case people don't understand it, banks make money when they lend money, right? And they make their spread on interest rates. Like that's what they charge. That's how they make their money. So just in the same way that a tire, like a car tire wholesaler or a car tire, bloody retailer or whatever will buy a tire for whatever $100 and they'll sell it for 150. That's the spread. They make the spread, and banks do the same thing with interest rates. So interestingly, they don't actually really make any money when with your savings and stuff. They don't, right? So, but in order for them to be able to lend more money, they need to have a stronger balance sheet, right? So the way that they get a stronger balance sheet is they take more deposits. And by taking more deposits, they build up their cash reserves, and then they're allowed to lend on a percentage basis of how much cash reserves they've got at any given point in time. So the only reason that banks take deposits, and the only reason you can put your savings in a bank, is so that they can give out more debt. That's the only function. So banks are purely they're a debt facility, and everything else that surrounds it is just some other mechanism to give them a better capacity to be able to sell more debt at an advantageous price.
Sweet. That makes sense.
Yep.
Cool.
Next question.
Look, I know you want to get into the meaty stuff, but I just want to touch on, so like,
I'll talk about whatever you want. I'm like putty in your hands.
When you apply for a loan or a mortgage, you get basically offered a rate from whichever lender you're going with based on a whole kind of range of things. And I just kind of wanted to touch on like some of the aspects of what may affect your interest rate that you get offered when you're applying for a loan. So very high level, and it changes all the time, right, depending on a lot of different factors. But if there's a fixed or variable option, for people, generally speaking, a fixed rate is going to be slightly lower than a variable rate because the lenders usually like to think of locking you into a contract like at a fixed amount is a preference to a variable rate where it chops and changes. And then if you're going to buy a PPR, so your home or an investment property, generally speaking, PPR rates are slightly lower than
Can I just jump in there? It's because the reason that fixed rates are typically lower than variable rates is because they're harder to refinance out of.
Mm-hmm. Yep.
So the reason that fixed rates are typically lower than variable rates is because you've got less options. So what they'll do is they'll say, hey, we'll give you the loan for cheaper, but we'll force you to stay. And then if you want to break the fixed period, they have what's called a break fee, right? So they'll typically charge you the difference that they would have made if it was a variable rate home loan. They'll charge you that difference and make it up anyway. So what they're trying to do is they're trying to create stickiness, right? They're trying to and just to talk to that again as well, because debt is another asset that they have, right? So the stickier the debt, the more fixed amount of debt that a bank has, the more value that bank has, right? So the idea is they want to create as much stickiness. They want to make it as hard to leave as possible. So it's much more optimal for them to have people stuck or fixed into loans for longer periods of time.
Yeah, for sure. And so with the stickiness, it's kind of like the opposite of the stickiness. Like the less sticky you seem to be to the lender usually results in a higher interest rate is what they're offering you.
Yep.
So that comes down to like what we were just saying, fixed or variable. The same thing with PPR, so your home or an investment property. Generally, you're going to be stickier if you are buying a home than an investment property, because an investment property you may end up refinancing in a few years versus a home you may be more likely to stick with that lender, right?
Totally.
And the same thing with interest only or principal and interest loans as well. So they can affect your rate. So generally, a principal and interest rate is actually going to be slightly lower because you're deemed as more sticky than an interest only loan.
Also, would say it comes down to risk profile as well, right?
Totally. Yep.
Because in an interest only loan, what you're saying is I'm going to keep all of the profits in cash and I'll hang on to them, thanks. On a principal and interest loan, you're saying I'm going to put some of my profits straight back into the bank. So the bank's going, well, what I'm going to do is I'm going to be shoring up my balance sheet faster. So then they're going to be able to lend more on the deposits they hold within the bank, right? So it's better for them, it's lower risk, and they have more benefit because then they can re-lend on the capital that they have on the balance sheet, right? So they have less liabilities and more assets, which is why the interest rate's different.
Yeah, 100%. And so all of these factors are layered with, the level of stickiness that the bank thinks that you are going to provide to them as an asset. And how risky they deem you to be in terms of sticking around and meeting your repayments so that they're not coming up short when you miss a repayment, basically.
Totally.
So the better that your situation and your history looks to a bank, and we all intuitively know this, but the better that your situation and history looks to a lender, the less risk you appear to be, so the better your offer will be, generally speaking.
Mm-hmm. Yeah, 100%. Because I think another thing on that is, like, around the risk profile thing, is that you can, if you don't have, maybe you're a business owner or whatever, and, for a variety of reasons, you might be able to get a low doc loan. And a low doc loan is typically a loan where they accept less of the verifying documentation to prove that you're able to repay the loan. And so they take a higher risk, and therefore they charge a risk fee, basically, and also increase the interest rate. So, that extends all the way to getting, quite high risk loans for property developers and stuff. And so these are quite common as well. Just because you get a high interest rate loan, it doesn't necessarily mean that, you're a baddie or whatever. It's like there are, it's quite common for property developers to pay 10, 15, 20% on finance, because it's going to bridge them between two situations where they can get more advantageous finance. And the same thing can happen for individuals as well. So understanding that interest rates are just a factor of risk is quite important as well. So
yeah, for sure. And I think so with, if you think about generally investment properties, if you think like positive cash flow versus a negatively geared asset, like that in itself, a positive cash flow asset, regardless of how much of the rent ends up being applied to your serviceability moving forward, because there's back and forth arguments about that. But generally speaking, having an asset that covers its expenses lowers your risk in the eyes of the lender, because you are at least going to be able to cover the repayments regardless of your situation.
Yeah, 100%.
So that's kind of how that factors in there. Yeah. Cool. You want to get meaty?
I want to get super meaty. Because one of the implications, right, of inflation that we talked about last time is that so let's just recap a little bit. Inflation is a sign that the economy is going good, right?
Yep.
But sometimes you can have too much of a good thing, right? And that can actually then start going bad. So firstly, what the government's trying to do is trying to stimulate growth, and they're trying to stimulate inflation. But then the natural throttle for inflation, right, is to increase interest rates. And the inverse is also true. So, for example, when the GFC kicked in, it was like interest rates got slashed, right? Because they had to try and stimulate more growth, because they were like, oh my God, there's been a break in production. Everything started to collapse. How do we stimulate? We need to stimulate more production. We need to stimulate more economic opportunity and all of this kind of stuff. Let's cut interest rates, bang, right? And that helps. And so the inverse is also true, so that when the economy starts to go, not if, you can't pump hundreds of billions of dollars into an economy. There's roughly $200 odd billion worth of quantitative easing getting pumped into the economy, and 23 million people. Do the maths. That's a lot of dollars per person, right? Getting pumped into the economy right now. And so you can't do that and not have it grow. So the natural implication is that at some point, interest rates are going to rise. Now, the RBA is saying not until 2024. Some people are saying sooner. The end of the day, no one knows. Even if it does go up in 2024, how much will it go up? Not sure. There's all these kind of things. But given that real estate isn't, or it shouldn't be, a short-term game, yes, you're making decisions that are going to make sense in the short term, but you're also going to make decisions that are going to make sense in the long term as well. So you also need to be thinking about, well, what happens when interest rates rise? Now, the argument about how much they rise, who knows? That's just pure crystal ball stuff, right? Could they rise from a cash rate of 0.01 or whatever it is at the moment to to 3% cash rate? Don't know. Are we likely to go back up to 17% like it was in the 80s? It's possible. Yeah. There's precedent, right? It's possible. Likely, I don't think so, but realistically, I think we should expect that at some point in the future, interest rates are going to go up, either by a little bit or by a lot. Mm-hmm. So I think it's a problem, and that's actually a good thing, because that says that the economy is doing well, right? So people shouldn't, again, be like, oh my God, interest rates are going up. This sucks. The world's going to end. It's like, oh, okay, cool. I guess things are going pretty well then, hey? Nice. Mm. So that's why I think it's a really interesting thing to really look at and to think about, and to go, okay, well, what happens if that happens?
For sure. And I think it's, it's just being realistic, right? It's not being, people might think about when you're planning for the worst that you're being quite negative or pessimistic or that kind of thing, when it's as you like to say, pragmatic optimism.
Yeah. Ruthless pragmatic optimism. It's like, okay, cool. That's likely to happen. Sweet. Where's the upside?
How do we make the most of it?
Yeah. How do we make the most of this?
Yeah. Cool.
Yeah. So there's a whole bunch of stuff that I want to talk about, but I think there's a couple of big fears that a lot of people have. It's like, well, what happens when interest rates rise? How does it affect property prices? How does it affect rents? What can we, and this is again an extension of that conversation of like, what happens if we get inflation, right? This is the extension of that. Now, going back to that conversation, there was like if in an inflationary environment, asset prices rise, and part of that is because that the relative value of the dollar goes down, and it's kind of like all these inverse equations, right? But basically asset prices will go up. Awesome. Okay, but but then they'll raise interest rates, and then what's that going to do for the property? Does that mean property markets crash? Well, no, not necessarily. So, I mean, I could wax lyrical about this all day, Gabby, but I'm interested from your perspective. Where do you want to start? Is there anything you want to dig into first?
Can we just start with like what, in an environment where interest rates go up, right? Raising interest rates, what generally happens to property prices?
That is it's a very good question, right? What generally happens to property prices? Because most people think that interest rates affect property prices. Mm-hmm. And whilst there is some evidence to support that, it is not very strong, and there is not a lot of it, right? And I've got I collected a bunch of stats here to support that argument, right? So over the last 30 years, interest rate rises haven't actually resulted in the fall in median house price. So I'm going to go through a few of these because I think they're really interesting. Sure. So rates rose from 14% to 17% in 1988 to 89. And at the same time, the median house price rose by more than 35%. Right? So interest rates went from 14% to 17%, and house prices rose by 35%. Crazy. Then there was a fall in interest rates from 17% to less than 9% between 1990 and 1993. And then that also had barely any change to the median house price, right? Or pretty much like no change. There was no noticeable differentiation. Okay, hang on a second. So interest rates have gone up, prices go up, interest rates go down, and nothing really happens. Interesting. So then interest rates went up again in 1994 by about 2% in a year, and then the house price continued to just generally rise, not in a crazy way, but in general, like 6% a year type way, right? Mm-hmm. Then there was an increase in interest rates from 6% to 8% in 2000, and it basically didn't have any impact on the property market at all. Like the property prices continued to rise, nothing really changed. There was not even any blip in the median house price Bollinger Band. So there was rate increases again between 2003 and 2008, which basically did nothing. House prices drifted a little bit sideways and then continued up. And then the GFC hit, and then the GFC hit, and the RBA made cash rate cuts throughout 2009, dropping interest rates by about 3.5% in 9 months. Now, at the start of the GFC, the median house price fell a little bit, but that was largely because of fear and the psychology of the market. I would suggest rather not the fact that interest rates went down. I don't think interest rates going down caused the housing market to go down. I think it was the fact that the whole world was in turmoil and everyone was just scared.
Yep.
And then the median house price went up again. And then the interest rates went back up to nearly 8% by 2011. So 2011, they were nearly 8% interest rates. And then the house price just continued to go up and then continued to accelerate and continue to accelerate, right? And so this trend shows that as at best, historical facts, is that sometimes when interest rates fall, the median house price rises. Sometimes. Not always, but sometimes there's some merit to that, but there's less to suggest that the interest rates, a rise in interest rates will necessitate a fall in prices. In fact, the evidence just does not show that. And what I find most interesting about that analysis is the lack of correlation. Like it's the complete lack of correlation. You can draw 2 light points in the sand and say, hey, what happens to house prices and what happens? But they're not actually linked because there's no consistent pattern, which I find truly, truly intriguing. What do you think?
Yeah, because you would think in a general sense that, supply and demand. So when prices go up, referencing again the last episode we did when we were talking about the paradox of thrift, where when prices go up, more and more people want to get in because it's the cheapest that, from their perspective, the price that it is today is the cheapest that it's going to be for the foreseeable future. So there is more demand to buy something today. Yeah. So that pushes prices up, right? Because there is more demand than supply at that point in time. And so that's kind of what happens when interest rates are low. So like now in the scheme of modern Australian history, interest rates are relatively low.
Extremely low, record lows, never ever been lower.
Yeah, and so there is I would assume, a correlation with the demand for getting mortgages basically at the moment because interest rates are so low because the cost of money is so low. So you would imagine that the inverse would be true, where if money is suddenly more expensive and the rate goes up, then there would be a decrease in demand, and so prices may not like drop, but you would imagine they would at least stagnate or slow down a little. But
yeah, so there's a couple of interesting there's a couple of interesting things I'd like to point out there. So and I'll talk about Sydney, and I'll talk about Sydney largely because this has been really reported quite a lot lately, is that the housing market in Sydney's been going bananas, right? But that's largely been driven by homeowners, right? And that's largely been driven. So even though prices of properties have gone up, because interest rates have gone down, home ownership affordability, key words there being home ownership affordability, is at an all-time high. Right. And so that is why there are more homeowners trying to get into the market, where it's typically in a market that's been typically very tough to buy in as a homeowner because of the affordability side. So there's three things that drive property markets more than anything else, right? So there's infrastructure or infrastructure jobs, right? So they're wound together. Affordability and lifestyle, right? And so you've got to look at those fundamental characteristics. It's actually not interest rates, right? So interest rates can have an effect on affordability, right? But sometimes that impact is negligible. Now, in a market like Sydney, the impact was significant enough to cause an increase in home buyer demand and people wanting to upgrade or downsize and do all kinds of stuff. But that's not the case everywhere, right? And so. So to that degree, it's very interesting to think about the fact that we're in a national boom, property market boom at the moment, isn't actually to do with interest rates. It's actually to do with a whole bunch of other extraneous factors. It's actually got to do with internal migration. It's actually got to do with psychographics. It's actually got to do with the decentralization of the industrial and commercial centers, because the cities can't keep up, the major capital cities can't keep up with the infrastructure requirements. It's got to do with the fact that, there's, over $200 billion of cash sloshing around in the economy, over $600 billion of total stimulus since the start of the COVID-19 pandemic. These are all the factors that are driving it. It's actually not interest rates, right? Interest rates, low interest rates for a property investor is like sweet because that increases cash flow, right? And also actually increases the affordability of getting a loan and the impact of your ability to get a loan. So, for example, I got some other numbers here, right? So if these are not the numbers now, right? But like if you were to get a 30-year mortgage on a home worth $400,000 at 4% interest rate, the monthly repayment would be about $1,900. But for a 5% interest rate on the same mortgage, same property, it would be $2,138 a month. So a 1% increase in interest rates increases the repayments by 13%, right? Which is pretty significant. So when you think about that, you're like, oh, bam, okay, it's free money, right? So that's why it's cool. But the impact on the ability to borrow based on the impact of cash flows is where it's really interesting, because if using the same context, a $400,000 mortgage on a 4% interest, if you're able to get a $400,000 mortgage at 4% interest, if it was at 5% interest, you'd only be able to borrow about $355,000, right? So that a 1% increase in interest rates could decrease your borrowing power or your purchasing power by $45,000. Okay, so this is what the real impact is. So when interest rates are lower, it does allow people to buy more properties, and that's cool. Right, and it also increases cash flow. However, it's still actually statistically doesn't actually make an impact on property prices. Volume of transactions, perhaps, but you've also got more people buying and you've got more people selling. So I think there's a whole bunch of stuff to unpack here, right? Because also when interest rates go up, rents also go up, right? Which sounds way counterintuitive, right? So the thing to remember is if you're a property investor and you're in an inflationary environment, right? Oh, property prices are going up. Bazinga, that's awesome. Oh, wait, hang on a second. Interest rates start going up. Well, what happens then, right? Obviously, the cost of debt goes up. Okay, so your cash flow may be depleted. So that can then seem like a bad thing because you might be like, oh, hang on a second, I might not be able to afford to hold this. However, home ownership affordability also goes down. Home ownership affordability also goes down, right? And so guess what that means? People still need a place to live, right? Yeah. So then there's more renters, which actually increases rental demand, right? And not only that, most investors also have more of an inclination to increase their rents because the cost of debt is higher. So they're more hawkishly watching like, when can we raise rents? When can we raise rents, right? So like, you know, across the board, broadly speaking, you see rents typically get risen a lot more during a high interest rate environment because property investors are trying to preserve cash flow. And also there's more rental demand, which puts more upward pressure on rental prices. So you sort of get this situation where if you're in the market, right, you're actually in a good position because you're going to have the benefit of, you know, increasing asset prices and also increasing rents. So I actually find it because it seems super counterintuitive. You're like, oh my God, interest rates are rising. What a horrible time to be a property investor. It's like, well, not necessarily. Now, where it can go wrong though is when you've got low yielding properties, right? So that's where it can go really wrong because the impact of the increase in the cost of debt may not get offset by the increase in the rents, right? And so you may end up with a net negative deficit.
Yeah, and you imagine like in that example that you gave before with a 4% interest rate, if that changes by 1%, like it's a 13% increase in your repayment. So if you're negative cash flow, like that can be, depending on the loan amount, right? But that can be a really substantial amount to add to your repayments to cover every month. And you're right, like in most situations, you'd imagine in that kind of a asset, it's harder to then increase rents. Like if you've got a property that's renting out for $300 a week, it's difficult to then go, well, I've got to increase it to $400. You can't really do that in most places. You can't jump up that quickly.
Yeah.
But the inverse, like the costs can jump up that quickly.
Yeah, 100%.
Yeah.
Yeah, exactly. So there are definitely some impacts, right? So what it will mean for property investors is that their ability to get debt will decrease, right? Because the cost of debt will increase, which is actually, again, why it's important to make sure that you've got higher yielding properties, because you'll be able to offset some of the impact of that using cash flow from your properties. Number one, right? Number two, it's going to increase the cost of your debt. Number two, it's going to decrease the amount of debt that you can get. But also, if you're already, for the properties you already hold, it's likely to actually create a net benefit across the board. So I sort of think it kind of balances itself out, right? And then, so if you sort of think about it like that, okay, well, it's probably going to balance itself out on a macro, then the whole fear around interest rate rises goes away. Now, where it really sucks, right? Where it really pinches is for homeowners, right? Because homeowners, nothing like if you own your home and your interest rate goes up by, if the cost of debt goes up by 13%, I'm pretty certain your wages wouldn't have gone up by 13%.
Yeah.
Right. And so that's where it really bites. And that's why, in fact, when interest rates go up, less homeowners buy into the market because the affordability is low. So I think about my parents. They bought when it was 17% interest rate. They told me about this before, and I'm like, what? That's just insane, right? And so when you have non-income producing debt, the impact is much more significant, right? And in fact, it lends much more credence to the idea of rent vesting during a high interest rate environment, because it's like, well, it's probably going to cost you, the impact is going to be lower, and then the impact of your whole financial ecosystem is going to be more advantageously offset, because you're going to be able to adjust the revenues within your properties and be able to adjust your portfolio based on the needs and the costs of debt. But you can't do that with your home. Like unless if interest rates went up by 2, 3, or 4%. I haven't done the math. I haven't done the maths of that. But if 1% is 13, if 1% rise in interest rates is 13% impact on borrowing, right? So I'd hate to think what 4% rise in interest rate might be, but it's totally possible that there's precedence of that happening. And if that were to be the case, I would suggest that your income is not going to go up by that much, right? So, so it can be a pretty gnarly environment.
I imagine it's a good. Not a good situation, but if you were going to do like a debt recycling strategy as well, it would be this kind of environment where you've got this asset that isn't producing any income, that is suddenly getting more and more expensive to hold, and you can kind of think strategically and do anything you can to get more leverage and more yield out of those assets using something like debt recycling.
Yeah, 100%, absolutely. It actually becomes really, I think, essential, right, to be able to do that. So, and I'm just hypothesizing here, but and I haven't really put any thought into it prior to making this statement. But perhaps it's more advantageous in a high interest environment to just do interest only, so that you can pay down your home. And there's probably maybe more benefit in it. I'm not sure about that, but you certainly have to rethink how you're approaching your financial strategy. But the important thing to remember though is I think there's like a couple of big takeaways here. Interest rates don't affect property prices, right? Like loads of other factors do, but it's not really interest rates. Interest rates do affect affordability. Yes, they do affect the amount that you can borrow. Yes, they potentially impact volumes of transactions, sure, right, but they don't necessarily impact property prices, right? So don't get all upset and think, oh my god, prices are going to go up or prices are going to go down. What inflation will cause prices to go up? An increase in interest rates will cause rents to go up, likely, right? And it probably won't have any impact on property prices. So it lends a lot of credence to the idea of being firstly, number one, a property investor rather than a homeowner, and secondarily, a property investor that focuses on positive cash flow as well as growth. I think is a really great way to position yourself, which is fundamentally where, when after we made our first property mistake and we started on this journey together, this was the premise on how we started to think about how could we position ourselves to have the lowest risk possible, situation, so we can make the most amount of money and have the lowest amount of risk, the maximum success and lowest risk of failure. And it all kept coming back to this idea that if your properties can produce a positive cash flow, you're going to be positioned to weather pretty much any economic storm. And I think this is another credence to that. What else? What haven't we covered? What haven't we covered that you want to know?
Oh no, I was just thinking about how, like, I think in particularly this environment, right, rates are particularly low, and they have been for the last few years, and a lot of particularly investors get in thinking like they're going to get a yield that kind of just covers that, and they're happy that they're getting something positive, but not really thinking about the positioning of that asset in a location that is actually going to increase in yield over time as the rates increase. And I think it's like, yes, yield matters, but it's also like the location that you select needs to have a trend towards it is going to further increase in yield alongside interest rates.
I think you touched on a really good point there, because cash flow, like if you like the pure way of measuring cash flow is actually not with all the expenses. Like net operating cash flows is the cost of debt, not cost of expense. Anyway, basically the very simple way of thinking about it is does the rent cover the cost of debt? That's the simplest way of thinking about it. And a lot of people think about it like that. It's very simple, very, very simple way of thinking about it. It's obviously not true because you have heaps of other costs like rates and property management and stuff. But when the interest rates go down, that really lowers the bar, right? And so then all of a sudden you get people going. I was talking to a guy last week, and he's bought it. He's got a couple of properties. He's got an apartment and a townhouse, right? So naturally, we spoke about that quite a bit because that I think he was trying to tell me how good his investments were. But we had a good conversation, so I'm not trying to
they have their place.
They have their place. But his yield was like, he was saying he's got really good yields, and I think one's at like 4% and one's at like 5%. And the problem is when interest rates go down, people lower the bar, right? And they go, oh, well, 4% is good enough. It's like my interest rate is like 2.5%. So sure, whatever, right?
Yeah. They think about the spread between the interest rate and the yield, and they're like, it's 3% there. We're golden.
Yeah. Exactly. Oh, my interest rate's only 3% and, my yield is 4%. Happy days. Now, cool, all good. It's maybe a time and a place for those kind of properties, and all good, happy days. But the problem is if the interest rates go up to 6%, you're going to find yourself underwater pretty quickly. And so, and this is the kind of pressure test that I don't think a lot of people are doing. And people, I know for myself, I don't really remember 2011, right? Like I don't really remember 2000. I remember the GFC and I remember all the stuff going on.
I definitely don't remember interest rates in 2011.
Well, apparently they were like 8%, right?
Yeah, I don't remember that at all. Yeah.
And so there's people today that moaning like, oh my God, I could only get a 3.2% interest rate. I better shop around more. I better shop around to find a different broker, someone who can get me 0.1% off. Now, don't get me wrong. It has an impact. Of course it has an impact. But you got to remember as well, in today's environment, it's literally the best that it's ever been. And so I think people can get a little bit obsessive about interest rates. What you want to look at is your affordability, your borrowing power, and all these other factors, right? And if you're buying well, if you're buying good properties that are producing a good yield and they're in a good location where there's going to be ongoing demand and it's going to make sense to hold for the next 5 to 30 years, awesome. Great, just go and do that. And in fact, what's more important than shopping interest rates is your access to capital. Is the most important thing you need to focus on is your access to capital. So, yeah, I think a lot of the time people seem to be splitting hairs. Someone's got a 2.7% interest rate, somebody else got a 2.8% interest rate. It's like, I mean, if that's the thing that's going to make or break your property investment strategy, I think, you've basically got a house of cards, right? So.
I think that tends to happen with people when, they might be further into their investing journey and they're a little too zoomed in on the details because they've got like the macro is worked out. So they're just kind of focusing like, where are these tweaks that I can make? Like, where are the rates that I can change along the way? Where can I increase my rents by $5 a week? That kind of stuff.
Yeah, I agree. But like, I don't know that's what you're not going to find gold in the weeds, basically, right? Mm-hmm. Cool. So does that kind of, do you reckon we tackled this, the topic of interest rates well enough? Was there anything that we didn't cover that we should have covered, do you think?
No, I think we did good. I'm really quite interested in the whole that it doesn't really affect property prices.
So counterintuitive, isn't it?
Yeah, I think that's a really interesting takeaway.
Yeah, it's really fascinating. And it's one of the biggest. So there's a lot of big myths in real estate, like loads of them, right? I'm sure like any industry, right? The myths that you can't get growth and cash flow, you have to do one or the other, like, oh, that's ridiculous. The myth that, interest rates drive property prices, not true. So there's all this kind of stuff out there. And I really like this one because it's so counterintuitive, because you would naturally think, but the evidence just doesn't suggest that. Like if you put the Australian median house price on a chart along with home loan interest rates over the same period, you'll see that since the 1980s, interest rates have gone down, and you'll also see that property prices have risen. Mm-hmm. And so you'll see that, and it's very easy to draw a distinction from that to say, oh, well, therefore interest rates have gone down and property prices have gone up. However, that would be to misinterpret the data, because property prices compound and grow over time in line with inflation and demand and all of these other factors. And so what you actually need to look at is what are the significant events where you might see a statistical anomaly. And there's a lot of opportunities to see statistical anomalies within that data. And like, when interest rates have risen sharply and literally nothing's happened to property prices. So yeah, I think it's a really fascinating takeaway.
Do you think there's any like correlation, if not causation, between like the inverse of that? So like when property prices are going too high, that interest rates actually end up getting dropped as a result of property prices going too high? So instead of the other way around, where interest rates go up, so then it causes a resulting like flattening or decrease in prices, which there doesn't seem to be a correlation with.
There's no correlation. So from a government perspective, when they need to put the brakes on house prices, mm-hmm. it won't be interest rates. That's not the lever that they pull. What they do is APRA, the Australian Prudential Regulation Authority, puts better controls or stricter controls on lending policy. Totally
interesting. Yeah,
it's a totally different lever. And in fact, Philip Lowe has openly said that. He's said that his job has got nothing to do with property prices, right? And if property prices start to get too carried away, it's APRA's job to deal with that. And APRA have said, well, we're not actually that worried about it because property prices aren't even, really doing anything crazy. So it's all good. And there's no risk. Doesn't look like there's high risk lending or anything like that. Mm-hmm. So if they want to put the brakes on property prices, it'll be through lending policy. That's interesting. Yeah, cool. Sweet. Okay, guys. Well, I hope you've enjoyed this episode, and I'd love to know your key takeaways from it. So send us an email, hello@dashdot.com.au. And as ever, we look forward to seeing you on the next episode. See ya. Bye.